Well, let's take a moment and look at the disclaimer. This content for educational, informational, entertainment purposes only, and nothing should be taken as a recommendation to buy, sell, or hold any securities at any time. We're here just to spread the word of how BTA analyzes markets, how we look at the markets, but nothing should be taken as a recommendation. This is Rod from BTA, and we are known as the middle traders. We are not going to get in at the exact bottom, and we are not going to get out at the exact top. But we we do make a lot of money in the middle. We are the stock market masters. Okay, for this last video for today, we're going to take a look at the major indexes. Not the ETFs right now, but the major indexes themselves. So right here we have a daily chart of the Dow Jones Industrial Average. Okay, this is a daily chart of the Dow Jones Industrial Average. And if you notice, with today's action, this is today's bar, daily bar, today's action. If you notice this white line, which is the 5-day, the green line here is the 9-day moving average. The yellow is the 21, and the red is the 50-day moving average, okay? Now, if you notice, today, we found resistance right at this downward trend in 50-day moving average, okay, on the Dow Jones. We got up to the 50-day moving average, and we got rejected. Now, look, the same thing happened last Friday. We traded up to the 50-day moving average, and we stopped dead on it. We closed directly on the 50-day moving average. Today, we opened up at the 50-day moving average, traded up just a little bit, and pulled back. So the 50-day moving average, this downward trending 50-day moving average, is acting as resistance. We have to get above that. If we can't break above that on the Dow Jones Industrial Average, then you know quite naturally the DIA, which is the ETF, that's the security that we trade. That's the security that we trade when we want to trade the Dow Jones. That means the DIA. If we can't get above this downward trend of 50-day moving average, then the DIA is going to also stall. Okay, so we have to get above this downward trend in 50-day moving average. Now, a downward trend in 50-day moving average is not a good thing. That's telling you that the longer term trend of this particular index is down. Now, we had a first day rally attempt, okay, for the Dow Jones back on the 20th, May the 20th. And we haven't been able to get an actual follow-through day on the Dow Jones, okay? Yes, it's been trending up, but we haven't had that one day where we had a big percentage gain on above average, a higher volume than the previous day. So we haven't got that on the Dow Jones. But the main thing we have to look out for is this downward trend in 50-day moving average. We have to get above that. For 2 days now, the last 2 trading days, we found resistance there. And as we see, volume is coming back in. Remember, this was the holiday week here. It's going to be low volume at that time. But now it looks like volume is coming back in. We didn't really want to see this big volume coming back in on a down day, but maybe that's a sign that the regular trading volume is starting to pick back up. Okay, now let's look at the Standard & Poor's 500, the actual index, the Standard & Poor's 500. Okay, so this is a daily chart of the Standard & Poor's 500. And we haven't, we still had that downward trend in 50-day moving average, but we haven't traded back up to it yet, okay? But we have the 5-day moving average turning up. It did cross above the 9, okay? That's our bronze cross. And the 5-day has gotten now above this downward trend in 21-day moving average. So as long as, if we do pull back, as long as we can stay above the 21-day moving average and above this uptrend, if the 5-day moving average continue to trend upward and we can stay above it, hopefully it could pick up some steam and move back up toward the 50. But when we get up toward the 50-day moving average, which is the red line right here, this red line is the 50-day moving average, okay? When we get back up to the 50-day moving average, we got to try to get above it, okay? We have to try to get above it. If we don't get above that, this downward trend of 50-day moving average could be a very strong resistance level, okay? That's a very strong resistance level. And a downward trend of 50-day moving average is not good. We want to see an uptrend in 50-day moving average. Okay. Now we did get a follow through day on the Standard and Poor on the 26th. So on the 20th, we had our first day rally attempt right here. And then on the 26th, which was last Thursday, we got the follow through day. We went into the market on Friday. Today, okay, we did take some profits today, okay, and we're gonna let and see what happened with the rest. But we did take profits today uh, on some of our open positions. But we're waiting for the Bollinger Band strategy to try to signal. Well, we got the signal. We wait for the pivot week on that, but and then we may take new positions in the market. But for right now, it's we got some key overhead resistance that we're coming up against on the weekly chart and things of that nature that is telling us to be cautious. We put a video up earlier today, telling you all to be very cautious, that we're being cautious because we're coming upon the 8-week moving average, and that's acting as some very strong overhead resistance. So that's why we're waiting, and we took a little profit off, okay, and we're waiting to see what happened with that 8-week moving average. But as you've seen, the the Dow Jones Industrial Average is going up against the 50-day moving average, okay? So now for the Standard and Poor, what we're looking at right now, we traded below Friday's close, okay, which is not good, but we're still above the 5-day and the 21-day, okay? So let's see what happens tomorrow. Tomorrow, I think, is going to tell us a lot for the Standard and Poor. Okay, now let's look at the NASDAQ. So this is the NASDAQ composite, all right, the actual NASDAQ composite. And as you can see, we traded we opened up above Friday's close, which was good, but it pulled back. But the one good thing I can say is it pulled back right to the 21-day moving average. This yellow line is the 21-day moving average, and as you can see, it pulled right to the 21-day moving average, and it bounced off of it. So maybe this 21-day moving average can act as support for the NASDAQ. Well, we got an uptrending 5-day. We got kind of a flat 9-day. The 5 crossed above the 9 right here. That gave us our bronze cross. The price action did pull back, but it pulled back right to the 21-day and it bounced. So that's good. So maybe this 21-day is acting as support and we can move up, but then going to run right into this downward 50-day moving average, okay? This downward 50, now that downward 50-day moving average can be a very strong resistance, all right? We could get to that, find resistance, and get rejected. Today was distribution. Okay, we had lower prices on higher volume than the previous day, and it was above average volume. Well, we could look a little bit past this one day today because we know last week was a holiday week, so the volume would probably be higher today because it's the start of the first day of trading after the holiday. So we can expect that volume would be a little higher, but it's still technically going to have to count as a distribution day. Okay, so anytime you get a distribution, okay, or after the follow day, within 2 to 3 days after the follow day, that's a very negative sign. That could say that the follow day may fail 50% of the time. The follow through day may fail when that happens. So today, if we go back to the Standard and Poor, we had our follow through day last Thursday. Okay, so this is the second day. Okay, if you get a distribution within 2 days after the follow through day, okay, you start getting a distribution day with lower prices, with higher volume than the previous day. Even though this is a holiday weekend, this is still technically distribution. Okay, that right there gives the follow through day a 50% chance of failing. Okay, so we have to be very careful because we got the distribution day. That's another reason why we started to take some profits off the table, and we're watching that 8-week moving average. Okay, so it's a 50% chance that this follow through day is going to fail. And what does that mean when we say the follow through day is going to fail? Well, that means that we're going to undercut the low of the first day rally attempt. Okay, so that means that this market has a 50% chance of coming all the way back down to here, undercutting the low of the first day rally attempt. Now, if we come down and we undercut the low of the follow through day, all right, let me clear this up. See, this is the type of stuff that you're not going to hear from most people on YouTube, okay, because they don't even know this stuff, all right. We were taught by some of the old timers, some of the best. These people don't even know these things I'm telling you right now. So, I mean, we you got to appreciate what's going on right here, okay. So this is the follow through day, all right. If we come back down and we undercut the low of the follow through day, that's considered a follow through day undercut. All right. That kicks it up from a 50% chance to over a 90% chance of failing. All right. But right now, being that we got distribution, lower prices with higher volume than the previous day, okay, that is that's a very negative sign, and that gives us a 50% chance of failing, that the follow through day would fail. But for the follow through day to fail, a failure is when prices come down and undercut the low of the first day rally attempt. So prices had to come all the way down here, okay, and undercut the low of the first day rally attempt. That's a little bit over 3,800, okay. Um, that's a pretty decent drop, right? So we know right now that it's a 50% chance that the Standard & Poor 500 can go from 4132 down to somewhere around 38 and some change, okay? 3,800 some change. It can pull back. It's a 50% chance now that it could fail. So we have to be very, very careful. All right, we have to be very, very careful. Okay, so this is the NASDAQ composite. We didn't have a fall through there on the NASDAQ, but we have distribution. Okay, but like I said before, we did find support, find some support for today, right at the 21-day moving average. So hopefully we could gain some steam and head back up. Okay, this is the IWM. Okay, daily chart at IWM, which is the ETF that tracks the Russell 2000. And as you can see, we squeeze between the downward trend, the 50-day moving average, that red line, and the 21-day moving average, the yellow line. Okay, so this downward 50-day moving average could act as some very strong overhead support. So we got to try to get above this 188.66. We did trade up above Friday's close, right here, but it came back down. Okay, so once again, we tested Friday's close, but we traded back down. Okay, but this downward trend, the 50-day moving average, can be a problem. So we squeeze between the 21-day and the 50-day. All right. The good thing is that the 5-day has crossed above the 9 right here, which is a broad cross, and is heading up to the 21-day. Maybe the 5-day could keep coming up, the 21-day could turn, and the index, the IWM, can ride the 21-day and eventually break above this. But that's possible, and it can eventually break above the 50-day moving average. That's possible. But but we know that this rally has a 50% chance of failing right now because we had distribution within 2 days of the follow through day. All right, so here is a daily chart of the Dow Jones Industrial Average, the Guppy. All right, so you see the magenta line of closing prices right here has gotten right into the longer term moving averages. Now, all the longer term moving averages, the red moving averages, all the longer term moving averages are trending down and turning sideways. The Guppy got above the shorter term green moving averages here. This is shorter term, faster moving average. We got above that, and the faster moving averages are starting to twist and turn upward. But we got right into the Guppy, the magenta line of closing prices. This is the magenta line of closing prices on this Guppy chart. We got right into the longer term moving averages, and we starting to get a little turbulence. If we come back out of that and start getting into the green again, break below the green, then this whole trend may turn down again. All right. We have to be aware of that. These longer term downward trending moving averages can act as resistance. You see over here, it happened before. It can run up into the longer term downward trending moving average, find resistance, and come back down. So this magenta line is a line of closing prices. All right, it's a line chart of closing prices. So right now we're inside the turbulence of the longer term moving averages. On the Guppy chart, we got to see. Hopefully, it doesn't come back down and break below the faster moving average. If it does, remember, this rally has a 50% chance of failing. We can come all the way back down to these lows. All right. So let's now look at the Let's move on to the, I'm sorry, give 1 second here. Let's move on to a daily chart of the S&P 500 guppy. Okay, remember the S&P 500 is where we had our follow through day. Okay, we had our follow through day on the S&P 500. Now here we have the magenta line of closing prices once again. And once again, we inside of the longer term downward trend of moving averages. We came right up in here. We found some resistance inside of these moving averages. We got some turbulence in there. We may have some trouble getting through that. If we're going to pull back and we start breaking below the faster moving averages, then that could be a problem. Now remember, this is the index that we had our follow through day on. We had distribution within 2 days after the follow through day. It's a 50% chance of failing. So it's a 50% chance right now that this market could come right back down to these lows again. We have to be careful. It is a 50% chance of failure here. So it was wise for us today to start taking a little profit off. If the Bollinger Band strategy signals, maybe we can add to the position, take some new positions or whatever. We have to deal with that as the time goes on. You have to trade the chart, not what you think is happening. You got to trade what is happening. Okay, what is happening right now, not what you think is going to happen, what you want to happen, what you hope to happen. You got to trade what is happening. All right. And if that means we got to sit on the sideline, then that means we have to sit on the sideline. Now we got this downward trending, longer term moving averages. We got the magenta line of closing prices. We're inside of the turbulence here. Okay. We got to see if we're going to get above this. All right. The faster moving averages did twist and turn upward. Okay. But being that the magenta line of closing price is starting to get rejected inside these longer term moving averages, it could pull back. It could get back below the shorter term, faster moving average, and then this will probably flatten out and turn back down. Okay, similar to what happened here. Look right here. All right, look in this area right here. We got the magenta line of closing prices got right up into the faster moving averages. Everything twists and turned back down. Okay, so we have to watch out for the Standard & Poor's. It's a 50% chance that the rally could fail. All right. I don't know how many times I could keep saying that, but I'm gonna keep saying it until we get it. All right, because it could be an opportunity of failure. Okay. Now here is the Nasdaq Composite. Okay, this Nasdaq Composite. The magenta line of closing prices are right here. Okay, notice we got right up to these downward trending longer term moving averages on the guppy here. This is a guppy chart of daily prices, right? A guppy chart with the magenta line of closing prices. We got right up into these longer term moving averages, and we starting to get rejected a little bit. The faster moving averages did twist and they're turning upward. That's great. But now we need to see this magenta line of closing prices get through this. We got to get through these downward trending longer term moving averages. If we keep getting this rejection and get back into the faster moving average and they twist and turn back down, that's not a good thing. We got to be careful because we're coming into a lot of overhead resistance. We put up a video earlier today talking about the resistance that may be stalling the rally. Okay. The resistance that may be stalling the rally. Look at these downward trending moving averages on the guppy. This thing can get stalled. We have a 50% chance of this rally can fail at this particular point in time. So we have to be careful. All right. Now, this is the daily chart of the percentage of stocks above its 200-day moving average for the total U.S. market. The percentage of stocks above its 200-day moving average for the total U.S. market. It's only at 20%. So only 20%. Only 20%. You can see right here, we closed at the 20% level. Only 20% of the total U.S. market is above its 200-day moving average. That's not good. That means the other 80% is below it, all right? Well, here is the caution line of 40. This horizontal yellow line is 40. Whenever you get below 40, it's a problem, all right? When you started getting down here below 15, we was in complete bear market territory. We have come out of that, but we still only at 20%. 20% is not good, y'all. So it's not like this market is blasting off going to the moon. No, we had the start of a new rally. We got the lowest totals. We had a new bullish upswing. That's great. But did the upswing turn to a trend? Is it going to continue? That's another story. Right now, the breadth is telling us the total U.S. market only 20% of the market is above its 200-day moving average. And what Paul Tudor Jones say? If stocks are above its 200-day moving average, I'll be going long. If they below the 200-day moving average, I'll go short, or I'm just sitting on the sidelines. So we have to always be careful when stocks are below the 200-day moving average. We need to see more stocks participate and at least get back above the 40 level. All right, this is our caution line. When we get below that caution line, we got to be very careful. This is our 50 level. When you get back, a 40 level. When you get below 40, you got a little problem. Okay, you got a little problem. All right, so we got to be careful. And I apologize, y'all. This is not our caution level here. I'm sorry. This I saw this yellow horizontal line here and I misspoke. Let me repeat that now. Let me straighten that out. I apologize. We are below the 40 level right here. We're below the 40 level. This red line is our 40 level. This red horizontal line is our caution. That's basically that's our trouble line. When it gets below 40, we're in trouble. 50 is our caution. Okay, when we get below 40, here, this red horizontal line is our 40 level. When you start getting below 40, you got to be careful. You're in correction territory. You're trading down. When you get down here below 15% of the total of the total U.S. market, below its 200-day moving average, you're in bear market territory. The yellow line that I was talking about before, I apologize. This is just a support or resistance level for a fractal, right? But the yellow line that I was intending to speak about was the 50% level. Anytime when you start getting below 50%, that is our caution line. You can't see 50 on this chart because 50 is way up here somewhere, okay? We only have 40. I took a screenshot of this. So at 50, I have a yellow line at 50, and that's our caution. So anytime you get below 50, you got to start being cautious. When you get below 40, that's a red light. You could have trouble because now you're going into correction territory. So I hope I cleared that up. I apologize for that. I'm seeing all these yellows and red lines. It's a little late. I'm a little sleepy. Been up since like 3 o'clock this morning. So forgive me. Okay. So now look, this is a better representation of exactly what I'm talking about. So let's go through this, right? This is the Standard & Poor's 500, percentage of stocks in the Standard & Poor's 500 that's above its 200-day moving average, okay? Now look, let's clear this thing up that I screwed up before. Here is the red line. That's at 40. That's watch out. Be careful. We're in trouble. Only 40%, you're getting below 40%. That means less than 40% of the Standard & Poor's 500 is above its 200-day moving average. Right now today, we stopped at 35. So only 35% of the Standard & Poor's is above its 200-day moving average right now. When you start getting down here below 20 and 25, you start to get into correction territory. That's extremes, okay? That's really low. Right now we got back to 35. But we're still below this red line, which is the trouble. That means stop. Hey, we could be going into correction. The breadth, the number of stocks participating in a good, strong, long-term rally, upward move is really low. It's below 40. Stop and be careful. Here's the yellow line I was talking about before. It's at 50. That's our caution line. When you get below 50, you got to be cautious. Up here, this green line here, which is at 60, that's go time. That means over 60% of the market is above its 200-day moving average. Then that's a very strong, that we making money at that time. It's cooking. We in a good, strong uptrend, good, strong rally, good, strong bull market. We cooking. We haven't seen that for a little while now, okay? So that's what I was talking about with the red, the yellow, and the green. When it's red below 40, that's the 40 level. When it's below 40, we in correction territory. When it's at 50, this is the yellow line I was trying to talk about before. I apologize. All right, the 50 level. Okay, when you're below 50% of the market below its 200-day moving average, less than 50% is above its 200-day moving average. Less than 50% is above its 200-day moving average. That's caution time. When less than 40% is above its 200-day moving average, hey, be careful. Stop. Red light. Look, we could be going into correction. That's a problem. Right now, we're at 35. So there's no reason to have FOMO, thinking you're going to miss out because we got this little rally. the fear of missing out. Now, there's no reason to go through any of that. It's only 35%. We still well below the red line. If this market is going to rally and take off, we got a lot of time. Only 35% of the stocks in the Standard & Poor 500, okay, is is above its 200-day moving average. So we got a lot of stocks. Over 65% of the Standard & Poor still got a lot of room to go to get back above their 200-day moving average. So there's no reason to get anxious and nervous that you're missing out on something. Nah, you ain't missing out on nothing. Okay, here is the NASDAQ. The percentage of stocks in the NASDAQ that's above its 200-day moving average. Okay, now, right now, only 17% of the NASDAQ is above its 200-day moving average. That's not that great. When you start getting down below 15% and 10%, well, you're in extremely low. You had definitely extreme lows. It's definitely well below bear market territory. But right now, we at 17%. That's still bear market territory. That is bad. Okay, that is bad. We're well below the 40%, the red line, which is our 40% level to tell us, hey, be careful, stop. Only less than 40% of the Standard & Poor's above its 200-day moving average. Stop, stop, stop. Well, look, we well below that right now. We at 17, okay? And we could barely get above this internal downward trending trend line, okay? Which we've been riding that trend line down for a long time. Yeah, we're trying to bottom out right now, right? We're trying to bottom out. We're trying to bottom and get back up and start getting more participation, more stocks in the NASDAQ getting above its longer term 200-day moving average. But right now, we only at 17%. Okay. We had our follow through day on Thursday. Friday was nice, but today we couldn't get above that. We couldn't add to that breadth of stocks that's doing well. So that's not good. Okay. So we have to be careful. Remember, this rally has a 50% chance of failing right now. I know the volume was low because of the holiday weekend, but it doesn't matter. It's still technically a distribution day. And if you get distribution within 2 to 3 days after the follow through day, okay, the rally has a 50% chance of failing. That's just the bottom line. That's it. These rules have stood the test of time. Be careful. Okay. It's a 50% chance. So it could go up or it could go down. so now here, this is our go-to market breadth chart, right? This is our invisible chart of the advancing minus the declining, the differential invisible chart. This is for the Dow Jones right here, okay? And as you can see, remember, when the green line gets above the yellow and the red and gets above this horizontal red line, which is a zero line, okay? When the green line gets above the yellow, gets above the red, and gets above zero, that's good. But the best signals are when the 50-day moving average, which is the red line, and the yellow, which is the 21-day moving average of the differential, are both turning up. Well, the 50-day is starting to get flat and turn down a little bit. And the green line is starting to come back down. Well, whenever we get the green line getting above the yellow and above the red and above zero, well, we generate this little green arrow here, this little green arrow right here. We generate that little green arrow. That means that the market is probably going to move up for a little while. And we did get the follow today right after that. And then we got some more upward movement on Friday, but today is pulling back. So we need to see this come down, recycle, and head back up now. Okay, we don't want to see this come down and start breaking below the yellow and below the red. That means that this here rally, that 50% chance of failure, it might just fail, because if this green line start getting back below zero, all bets are off. Okay, this thing is probably going to fail. This green line got to come down. Maybe it could find some support right around the yellow 21-day moving average of this differential and start heading back up. If it start breaking below this yellow and below the red, and definitely if it gets below zero, now I'm gonna tell you that probably the rally has failed. Okay, forget the 50%. It's over. It's a wrap. All right, it's done. All right, so we have to see what happened here. We need this to start improving. We need these moving averages here to start turning back up on this differential chart. This never fails us. This here never fails us. All right, this got about a 90% chance of being accurate. Okay. This one chart right here, you're not going to see nobody else is talking about this chart. You know why? Because I came up with this chart. I created this chart. Okay. That's why I know nobody else is talking about it. All right. So this is the declining, advance to decline differential, daily chart differential. It's our go-to. It has never failed us. Now here, this is the same thing, but this is for the Standard and Poor 500. Our advancing minus declining issues differential invisible chart, okay, of the Standard and Poor 500. All right. And notice the green line now is above the yellow, it is above the red line, and it's above the zero line. Okay. It's above the yellow. It got above the yellow here. It got above the red and the zero line here. But the best is when the red line can start turning up. The yellow line did turn up, but now the green line is heading back down. If it start breaking back below the yellow, below the red, and if it get back below zero, this thing is in trouble. We already got a 50% chance of failing, okay? But we need this to turn around. If this start turn around, if this starts to turn around and head back up and these moving averages start turning up on this differential chart, then I'm going to tell you that maybe that 50% chance of success, okay, it's a 50-50. So maybe instead of failing, we might go to the 50% chance, the side of it that has some positive, development. It may succeed. But I'm telling you, this chart has a 90% chance of success. So it did signal our green arrow right here. When we got above the yellow, we got above the red, we got above zero. Our green arrow was generated saying that, hey, we're going to move higher. We did the next day get a follow through day, and that Friday we rallied up, but today it pulled back. Okay. And so it doesn't tell us how long it's going to go. It's just telling us within the next couple of days, it should go up. It ain't saying how long it's going to go up. All right. We have to monitor the chart to tell us that. And right now, I'm telling you, it's pulling back. The 50-day hasn't cycled up yet. Okay. If this thing breaks below the yellow, breaks below the red, and start heading back down, that 50% chance of failure may come true. All right. So be careful. Be careful. Be careful. I can only tell you what I see. All right. I told you I thought the market was bottoming. We did get a bottom. We bounced a little bit. I told you it might be a relief rally. We don't know if it's going to be a relief rally or we're going to get a little more. All right. I can only tell you what I see. And I'm telling you right now that I see it's a 50% chance of failure. And I see that this has to change. This has to change. And we got to watch them moving averages, that 8-week, them daily moving averages, 50-day. Be careful. Okay. Be careful. All right. Now, this is the NASDAQ differential chart, advancing minus declining, invisible chart, differential chart, okay? So the data is invisible. We're just looking at the moving averages to smooth out the data so we can see it better, okay? That's what's happening here. The data is behind. It's all grayed out. You see it's very light. You can barely see it. It's very choppy. That's the data. But we want to smooth that data out with these moving averages, okay, of that differential. This is a daily chart. Basically, what you need to know is when the green cross above the yellow and cross above the red and it get above zero, we generate this little green arrow. That means that we're heading up. We're going to be heading up for the next couple of days. How many days, how long? I can't tell you that. We have to monitor the chart to see that. But right now, you see, we are moving up. And you see the green line now is starting to come back down. The 50-day moving average of the differential, the red line, it never really turned up. Okay, we need to see this turn up. We got this little note here for a reason. The best signals are when the 50-day MA is turning up, trending up. It's not. It's been flat. We need to see it turn up. Right now, the green moving average, the 9-day moving average of the differential is headed back down. If it breaks below zero, trouble for the NASDAQ. Okay, trouble for the NASDAQ. The yellow 21-day moving average has never gotten above zero yet. Okay, we need to see this thing start turning up. But if this green line here gets below the zero line and this yellow line never makes it above zero and this red line stays flat, trouble for the NASDAQ. 50% chance of failing may be true. So, okay, look, in summary, we did get a little rally. It did rally. We got the fall today. It started moving up. Listen, this market is on the edge right now. It's very dangerous because the economy is shot, basically. Okay. Inflation is kicking everybody in the behind with all these supply chain shortages. It's kicking everybody in the behind. So we got to be careful. Any economic news coming out of Europe, like it did last night, 4 o'clock in the morning, Europe, coming out of Europe, these inflation numbers, Or any kind of little economic data can cause this market to go into a tailspin and collapse. The data right now is telling us things are not, it's rallying, but it's not giving us that strong blast off that we was looking for. And right now, our follow through day analysis, our price and volume action analysis is telling us that the follow through day has a 50% chance of failing. That means the rally has a 50% chance of failing. So be careful. In summary, be careful. Our Bollinger Band MACD strategy has not signaled. We are in the pivot week, but it has not given us the pivot. It has signaled, rather. I should rephrase that. It has signaled. Excuse me. We passed the signal week. We had the setup week, done. The signal week, done. But it has not given us the pivot. It has not given us the buy signal, the pivot, the go point, the go time, the green light. No, it's not there. It could have happened today, but it didn't. And even if it does happen, remember, we keep talking about those downward trending 8-week moving averages, that downward trending 50-day moving average. So even if it does signal, we are going to go in very, very slow, meaning we're going to take very small positions until this thing starts to prove itself, because we're not going to jump in there, buy a whole lot of shares, and this thing collapse on us. So be careful. It has a 50% chance of failing. I can only tell you what I see. Okay? So until tomorrow, hope everybody have a good night. We'll pick it up tomorrow. Look out for the videos tomorrow in the morning. We're going to go over the daily charts, the moving averages. We're going to go over the weekly charts. We're going to stay on top of this thing until the market shows us what it's going to do. All right, so take care. Have a good night, everybody.